Welcome to TheoTrade. This is Don Kaufman. It's July 19th, 2017. The rally goes on. Nasdaq up 33 handles. S&P's up some 13. I'm talking to a number of traders throughout the course of each and every trading session, traders that I've known for the last 15, 20 plus years, traders that I've known, some of them since I'm a kid. I kind of grew up around trading, and all of us have to agree we've seen some crazy things before, but literally here we're getting a handful, and it is just a handful of underlyings driving the markets. Clearly the S&Ps played a role today. Now, before we go any further, I want to examine the expected move thus far on the week. Okay, last week, and again I kind of highlight this a bit, but last week right in this neighborhood we exploded above the expected move, and it's critically important because you can identify this big kind of breakout to the upside. And for those of you, if you do not recall, I placed a upside hedge in the event this was going to occur, and this upside hedge, we put this together on Thursday. It was a Thursday in the Theo evening video on Thursday. This was the upside hedge. It was simply short the one contract of the 244.50 calls, long two contracts of the 245.50 calls. It was a ratio back spread, and I placed it kind of live throughout it. Now, I am unwinding those today, and I've actually gotten out of my ratio back spreads towards the close today, and I'll show you what the closing price of this trade happens to be. Ultimately, I did the trade for originally a 6-cent debit. I went ahead and got out of them for about a 70-cent credit. So again, I paid next to nothing for them. We got out of them for a 70 cents credit. Good, done, over with. Now, it was a nice hedge to the upside, and that's exactly why I explained it. It had nothing to do with the fact other than I had some positions that were taking some heat to the upside, and that ratio back spread helped alleviate some of the risk that I have to the upside. Now, examining the expected move, okay, moving forward. So this particular week, here's exactly where we start the week, which is roughly at what? 24.60. Again, we've taken off to the upside, but people, we still have a ways to go. The upper band of the expected move is just shy of 24.80. And in this particular circumstance, here we are, we're still about what? 6-7 points shy of the expected move for the week. However, and this is something we've been talking about an extensive amount, if you go look at the Nasdaq, and we'll zoom into the Nasdaq has actually accelerated above and beyond. In fact, it even breached its expected move for the week. And this is critically important to many of you that follow some of the trades that we do and we email out here at TheoTrade. We've been emailing out our tetrapod spread, and the tetrapod spread, we're buying premium in the Nasdaq, selling premium in the S&Ps. And right now the S&Ps are still inside the expected move. The Nasdaq, though, is accelerating right to the edge of the expected move. So the buy side of premium is working in this particular case. Now, this brings up a huge argument, and I discussed this in extent recently here at TheoTrade, and it has to do with buying options versus selling options, okay? And it's this age-old debate. Now, I grew up with the notion that you need to sell options, okay? And for the most part, really the vast amount of my career, I've always been a premium seller. Through thick and thin, I've been a premium seller. Well, when I started evaluating a lot of the data over the last 18 months, if you can see, and again, I'll just zoom into this one specific area, okay? This just happens to be the Nasdaq, and this is exactly 21 weeks of data, okay? So for the last 21 weeks, all right, you can count the number of times that we've actually breached the expected move. And that's, let's say, breach the expected move by the end of the week. And each one of these is highlighted. So this is exactly 21 weeks of data. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. This week, we're not even counting it. It's not done. This week could actually be 11. But right now, out of ultimately 20 weeks of data over here, what do we have? Okay. We have effectively 10 breaches. That is 50% of the time we're going through the expected move. Now, these expected moves, for those of you that understand the expected move in a little bit more detail, those expected moves, you're supposed to stay inside of them 68% of the time. So think about the edge in this. The edge is if you're on the buy side of options. Now think about this again, because the data is right in front of you, and we'll share these links and share the data. But if you're on the buy side of options in the last 20 weeks inside of the Nasdaq, the Qs specifically, okay, you're making money because the expected moves are being exceeded. Now, you know, one of our clients put together a script, and I started to really examine this a tremendous amount in recent trading. And what you're looking at over here is a script that takes and plots the expected moves for us, okay? And it further even labels the breach of the expected move. Moreover, up top over here, it even gives us exactly the number of breaches of these expected moves. So I started looking through some of the key stocks, and again, this argument, should I be buying premium or should I be selling premium? Well, as it pertains specifically to a handful of Nasdaq stocks, I mean, I don't think this is going to be too shocking over here to mention, but if you sold premium in Netflix, okay, this isn't about being bullish, this isn't about being bearish. If you sold premium in Netflix, okay, look at the number of times the expected move has been exceeded, and by what measure has been massive out there. If you look at a product like Facebook, okay, again, this is just the last 6 months, but again, this is a script. We're capable of pulling up 3 years of data. And throughout 3 years of data, you're even finding, forget about earnings, you know, even extract earnings from the picture. The number of times the expected moves are being breached warrants to be on the net buy side of options. And again, with all due respect, forget about direction for a second. When I'm talking about buying options versus selling options, there's no thought to this. I'm just talking about going out there and saying, hey, buy a call and buy a put, buy a straddle, which for years was touted as like, oh, that's the worst trade you could possibly do. You just buy a call and buy a put, and what are you supposed to do? Pray? Yeah, well, apparently that works. Okay, you look at something like Apple, and of course, you know, everybody's going to point out, let's go over just the last 3 months in Apple, and you can see the number of times this is the expected move from the week. And again, I want to highlight this as I draw it. That's the expected move for the week. This is a full breach of the expected move. In the following week, okay, is a full-on breach of the expected move. Okay, the next week is a breach of the expected move. Oh, here we have a week that we actually stayed inside it. The next week, huge breach of the expected move, which means you're blindly buying a call and buying a put in how many different expirations that you're making money. It's because when you talk about selling premium, the juice right now is not worth the squeeze. That is, what that ultimately means, okay, is when you look at like Apple options, the implied volatility is inherently low. And the actual stock price movement in many cases is exceeding implied volatility. It's a lot to think about. Again, as the market continues to kind of march upwards, we're getting an incredible opportunity to buy option premium. To say it's at a rock bottom price is an understatement. Okay? If you take a look at the product like the spiders over here, and you look 2 days out, okay, and we have what? $1.20 expected move. Some of the at the money options in here, again, this is with 2 days left, you look at implied volatility, but some of the at the money options, you're looking at a 5% implied volatility. All right, nothing good could come out of selling options in there. And then you start to mention like products like Tesla, you're like, well, Don, Tesla has much higher volatility. So I went and I did some data on Tesla. And Tesla was breaching, even because of it, just because it has high implied volatility, it didn't mean anything. This thing was even more likely to breach the expected move. And the expected move is just simply defined by, for example, you know, people are, oh, what is the expected move? If you went out there and just blindly bought a call, okay, and bought a put, all right, you're just buying a call and buying a put over here, buying a straddle, okay, and a vast amount of time, that straddle at some point between now and the expiration, it is in fact making money. A lot to think about over here. Have a wonderful evening, everybody. Enjoy TheoTrade. Bye-bye.